Welcome back to another episode of Palisade Radio. I'm your host, Karem Mamutlu, and on today's show, we have Matt Geiger, who is the managing partner at MJG Capital. Welcome back to the show, Matt.
Thanks, Karem. It's good to be back, and good to have you doing the presenting here on Palisade Radio.
Oh, many thanks. Okay, I want to start by talking about the mining cycle and where you think we are in terms of multi-year bull market for gold and the mining stocks. The excitement from early 2016 hasn't been repeated yet on a broad scale for the majority of mining stocks. However, certain high-grade stories from a few juniors have been on investors' radars. So what's your current feeling, Matt, surrounding the mining space, and are we actually still in a bull market?
Well, it's a good question, and I'm a bit mixed, Karem, I must say. It's hard to say definitively exactly where we are in the cycle. I'll start with what we do know. I think we can all agree that the mining market went through an absolutely devastating bear market between Q1 2011 and January of 2016. It was long, it was relentless, it was deep, and I think we can all agree that occurred. So there's no disputes there. Then I think most would also agree that we entered a new bull market in January 2016. Starting in January 2016, we had an insane 9 months where basically juniors of all stripes, whether they're focused on battery metals or base metals or precious metals, what have you, saw share price increases of 2, 3, 4x over that 9-month period. In some cases, it was even more extreme than that. We had one holding at that time, Almadex Resources, who we were buying in late 2015 when it was trading at the value of its working capital, go up 10x over that 9-month period, which corresponded with the discovery. So it was a very exciting time for investors in the space. Some will say that this bull market only lasted 9 months and ended in August, September 2016. I'm not of that view. While the year 2017 that followed wasn't nearly as excited as 2016, I still view that as a continuation of the bull market. And for some perspective, the fund was up roughly 95% in 2016 and then up roughly 50% in 2017. So while the gains weren't as exciting, I still very much view 2017 as a continuation of that bull market. So that takes us through the end of 2017. Going into 2018, I was very optimistic. I thought that would be the defining year of the bull market that began in January 2016. The year started hot. There was a really strong 3 to 4 weeks. I know the MJG fund was up close to 15-20% just in January of last year. But then stuff really hit the fan. And last year turned out to be a disaster for mining investors. I remember doing an interview with Colin in August of last year, so August of 2018, in which I said to him that we are not in a new mining bear market, and that a recovery was imminent. In hindsight, that was incorrect. That simply was not the case. The losses in the 4 to 5 months after that interview, as we went into year end, were so extreme that I think it would be delusional to say anything other that we were in a bear market. So now I am of the opinion that I was wrong, and a new bear market began in January of 2018. So now the question is where are we now? Are we still in that bear market that began in January 2018, or has a new bull market begun in the past few months? I would say the jury is still out. So to support the bull's case, it looks like there's a clear V-shaped bottom that formed in the TSXV with the low on December 21st, 2018. So for any listeners here, if you go back and look at the TSXV chart, there's a clear V-shaped pattern that ends right in the depths of tax loss selling. Okay, we've also had commodity prices in Q1 of 2019 that, according to Bloomberg, have had their very best quarter since Q2 2016, with commodities as a whole up roughly 7%. But many metals, including the base metals, we have copper up 10%, zinc up 23%, nickel up 22%. And this is against all expectations. People coming into 2019 were very bearish on base metals. So this has been a bit of a surprise. Also supporting the bull's case, we have the big diversified miners like Rio Tinto, and BHP trading within a few percentage points of their 52-week highs. In fact, it looks like Rio Tinto might hit another 52-week high today, perhaps. So that also supports the bull's case. And finally, just speaking from what I'm experiencing as managing partner of the MJG fund, we are up 46% year to date, so through March 31st. So pretty extreme outperformance, which is positive, and again, points to the fact that we maybe turned that corner in late December of 2018. So I don't want to make a definitive conclusion on this yet. I want to see how the market hangs in there for the next 60 to 90 days. And if these gains either consolidate or increase over the next couple months, then I will be confident saying that we are in a new bull market. But as of now, I think that the jury's still out and investors should be cautious. So that's the stance I am taking.
As a young investor and fund manager in the mining space, Matt, I'd be interested to know how you started in this space and how you came to the conclusion that mining stocks and commodities in general are the best place to risk your capital. Can you talk a bit about this?
Sure. So for whatever reason, and I am a younger guy, as you mentioned, I'm just 27 years old. I'm going to be investing in the space, God willing, for decades to come here. For whatever reason, the natural resource space has just made intuitive sense to me. And, kind of thinking through it, I've highlighted a few reasons why. The first is that I've always been a lover of history and anthropology. A big reader of those types of books. Jared Diamond is one of my very favorite authors. And I really do believe strongly that humans have completely taken for granted the way our lives have changed since the hydrocarbon revolution roughly 250 years ago. I mean, hell, the average human life expectancy has doubled since 1900. So in the past 120 years, the average human life expectancy has literally doubled. And I really don't think we appreciate how good we have it in the modern age. And, I'm not predicting that we're going to have a global apocalypse next year due to resource depletion. But I do believe strongly that the world at large is vastly undervaluing our finite resources in a time where both human population is growing exponentially and at a time where consumption on a per person basis is also growing exponentially. So for that reason, over the coming decades, I think this is a very smart place to be. And I feel confident that investing in resources when I'm 70 years old will be just as relevant, if not more relevant, as it is right now. I guess the second point I want to highlight is that there really is no industry, except for potentially shipping. But aside from shipping, the other very capital-intensive industry, there's really no industry that is more volatile or cyclical than the mining space, particularly the junior mining space. And I came to understand that most investors absolutely despise volatility and cyclicality, and they try to avoid it at all costs. And I realized that for whatever reason, myself personally, I was better able to stomach extreme moves better than most people. And I also came to realize that if you have a long-term time horizon, you could actually look at this volatility and cyclicality as your friends and not as an enemy, not as something to avoid. So I think if you have this attitude and kind of rethink your relationship with volatility and cyclicality, this is actually a great industry to be in. You have to take that long-term time horizon, but if you have that perspective, I think you're in a good position to succeed and excel in the industry. And finally, I would say, I'm a contrarian by nature. I'm not really sure why, but that's just the way I've always been. And I grew up in Silicon Valley, in Mountain View, where Google was founded, 40 minutes south of SF. And Silicon Valley couldn't be any farther away from the mining industry. It's viewed as dirty. It's viewed as old-fashioned. I had no friends, no family, nobody within my general vicinity that had anything to do with mining. However, I realized that all of these gadgets and inventions and things that were being invented and created in Silicon Valley would be absolutely nothing without the raw materials and the metals that underpin them. So whether it's the nickel and the lithium and the cobalt and the manganese that goes into batteries, or the rare earth metals that are going into our wind turbines, or the silver that is going into into our solar panels. Really, anything being built and created and innovated within Silicon Valley is nothing without these raw materials. And I realized there's this huge disconnect, and very few people realized it. So, that's another reason I was attracted to the space. I saw a lot of my peers going into other industries, and I figured, well, here's something that I can make a career out of, where there's not too much competition amongst younger people as well. So, kind of all of these factors added up, and that's kind of why I have this passion for natural resource investing.
Let's move on to the uranium sector, and I'd like to get your thoughts on the expected outcome for Section 232, and how important is this as a potential catalyst for the uranium sector in general? And let's get your current thoughts on the consolidation within the uranium spot price as well.
Yes, I'll address your second point very quickly. Uranium's a long-term investment. I think you need to have a 3 to 5 year time horizon. I am aware that the uranium price within the past week or two has dropped from, close to 30, I'll say $29 down to 26, which is one of the sharper drops we've seen in the past 6 months. However, I don't feel that this is underpinned by fundamental reasons, and it's not something that I've spent too much time on. So I'm taking the longer term view on that. In terms of 232, this is going to be a really interesting few months here. So for your viewers that aren't familiar, the Commerce Department has been doing an investigation that will be delivered to President Trump by April 14th. That's the date they've given. I've heard some whispers that it may be delayed a few weeks due to the government shutdown that we saw in January of this year. But for now, let's just assume that the report will be delivered to President Trump by April 14th. And this report will provide a recommendation on whether the U.S. should implement tariffs or quotas on foreign uranium being used in U.S. reactors. The number we're hearing and kind of the ideal scenario for U.S. domestic miners would be a 25% quota. And so the hope is that would be the recommendation to President Trump. Trump would then have 90 days to decide on whether to go forward with the recommendation. But it's worth keeping in mind that in a previous 232 petition, this about U.S. Steel, Trump made his decision within 2 weeks. So he acts quickly, as we all know. So we're going to get an answer pretty soon here. I'm obviously biased, given our large U308 position. I'd say roughly on a weighted basis, maybe 19% of the fund right now is exposed to uranium equities. But as an American as well, I do think this proposal makes sense. I think it's frankly pathetic and potentially dangerous from a national security perspective that we now supply domestically less than 2% of our domestic reactor uranium demand. This is particularly sad, given that just a few decades ago, the U.S. was literally the largest miner of U308 globally. So I think the thought process behind this is sound. However, the utilities are pushing back on 232, and the utilities do have a pretty strong lobby in Washington. And they're saying that the implementation of a quota or even tariffs would put a damper on the U.S. economy by increasing electricity prices and hence hurting GDP. However, this is a tough argument that they're making. And from what I've seen, the reaction will be quite muted on electricity prices. The number I've heard is that for your average $110 electricity bill, if 232 was implemented, it would increase the bill by roughly 11 cents. So we're literally talking pennies here, and it does not seem like it would have a large quantifiable impact on the U.S. economy. The reason for this is that in terms of nuclear power generation, the all-in cost of nuclear power generation, the feedstock is already such a low percentage of that anyway, because the vast majority of the all-in cost from nuclear power comes from the actual upfront capital cost of constructing the plant. So slightly higher prices for the actual input isn't going to have a large impact on the all-in cost. So that's why it's a tough argument that the utilities are trying to make. but it's one that they are making, and we'll see how effective it is with President Trump in these coming weeks. If I had to pick, I do expect Trump to implement a tariff or potentially a quota. I'd say tariff is probably more likely. Quota would be the best case scenario. The reason he would do this is it would give Trump an opportunity to do two things. The first is that he could tout increased mining jobs, which is a promise that he wants to deliver for his base politically. And more importantly, this is an excuse to bring up the Hillary Clinton Uranium 1 scandal, which was talked about so much during the 2016 election and really is red meat to his political base. So I think politically, making this decision would kill two birds with one stone. A, you get to create more mining jobs in the U.S. and fulfill a promise he made. B, you can bring up the Uranium 1 scandal again and then juxtapose himself to Hillary Clinton, which continues to be a big foe. So I think this would make sense for Trump politically. If Trump does act, it would be disproportionately positive for the U.S. Uranium miners like Energy Fuels, UR Energy, UEC, kind of the names that come immediately to mind. However, I don't think this would be the end of the world for companies with projects located outside of the United States, in Canada, Australia, Africa, Kazakhstan, you name it. From what I've seen, the specter of 232 has hung over the uranium market for close to a year now, and it's resulted in a lot of utilities, both in the U.S. but also foreign, from delaying signing any long-term fuel contracts. And I think once we get a resolution and once we get some stability one way or another on the 232 decision, we will see utilities, both domestic and foreign, come back to market for long-term contracts, which will be a net positive for the whole uranium space. So it will disproportionately benefit the U.S. miners if Trump were to sign this into law. But I do believe it'd be a net positive for the entire space. So in terms of the MJG portfolio, I don't want to go into particular names, but we're roughly 50% exposed to U.S. uranium and roughly 50% exposed to foreign. So either way, it's going to work out well for us. Kind of have my feet in both camps. So that's how we're playing it, and we'll be watching closely in these coming 2 to 3 months when President Trump is expected to make a decision one way or another.
You mentioned your fund, and from what I understand, it includes a mixture of base metal juniors as well as exploration gold stocks and uranium, as you mentioned. So could you give our listeners a sense of what you look for in a resource stock? And is there a set of criteria that you have to follow for you to take a position in a company? For every success story in the junior exploration space, there are many that fail or are simply mismanaged. So what have you learned from perhaps your losers as well as your winners?
Oh, that's a good question. I feel like I could spend an hour working through it point by point. I think it's difficult because there are so many business models in the space. Whether you're a prospect generator, whether you're a royalty co, whether you're a single asset explorer, whether you're developing an asset towards production, or whether you're a producer. And I use different techniques and different strategies to value all of those different business models. So it's hard to give one answer across the board. But the one thing I do want to focus on is insider ownership. And as cliche as it is, I really do believe in this space, you have to bet on the jockey and not on the horse. In other words, it's about people over projects all day, every day. The key here, especially for these early stage ventures, this is true in technology and biotech as it is in mining. The earlier stage the venture is, the more important the people actually are. And so I think the key is to find an honest, hardworking group that has had previous success in their area of focus. So in this vein, high insider ownership solves a ton of problems for you as an investor. So not only do you know that management's incentivized to work their butt off because they have a slice of potential upside, but also you'll see multiple things happen with companies with insider ownership percentages north of 10%. First, as a group, you'll see that they have lower expenditures on G&A, marketing, travel. Basically, they're a lot more judicious with their capital expenditures. due to their skin in the game. Additionally, you'll see less needless dilution for companies that have those high insider ownership percentages. And dilution is the absolute number one enemy of investors in this space. So that's another reason to focus on teams with insider ownership above 10%. And then third, you'll simply see smarter strategic decision making as these management teams only have an incentive to do transactions that are accretive on a per share basis. So you see far less empire building. You see far less companies doing deals just for the sake of doing deals. They have to make sense on a per share basis. That's what you should want as a shareholder. And that's what management tends to do when they have these higher ownership percentages. So I think if your listeners made a practice of immediately rejecting any opportunity with low insider ownership, their returns would be better. That's obviously hard to do. We do have a few holdings in our portfolio that have south of 10% ownership, but the vast majority are in the double digits. And the reason I say this is recently there was a fascinating study conducted by the Shareholders Gold Council, which was pulled together by Paulson in the past few years. And they looked at the effect of stock ownership of gold company CEOs and chairmen and the effect of that ownership on the company's share price. And long story short, they did a statistical analysis and found an R squared of 83% for the CEO and an R squared of 90% for the chairman. And this basically implies that of the share price outperformance they saw in the companies they studied, between 80 to 90% of that outperformance can be attributed to the larger insider ownership positions. So I thought this was a fascinating study. Again, this study only pertained to large gold producers. I think there are maybe 18 to 24 companies that they included in the study. But the message remains the same for the whole mining space and the junior space in particular. So that's a fascinating study. If any of your listeners are interested in looking at it, they can shoot me a note and I can get that to them. But I think that really supports the argument I'm making that investors should confine themselves to management teams with significant skin in the game.
Okay, as we begin to wrap up the show, Matt, is there anything else you wish to discuss today? I understand that you'll be speaking at the Palisade Conference in Jekyll Island in May.
Yes, I will. I'm looking forward to that. I was there at the last conference. It's an absolutely beautiful venue, and it's a fun, historic place to be. As many of your listeners may know, Jekyll Island was where the Federal Reserve was created roughly 110 years ago. So it's a good conference. I'll be there. The presentation I'm planning to give is discussing the 10 things that investors should look for when reviewing the presentations or slide decks of potential investments. So I hope that will be helpful to the audience members there. I'm looking forward to that coming up in mid-May. And otherwise, I think this has been a pretty comprehensive interview. I would just encourage your listeners that have money in the space to take a longer-term perspective here. While I'm optimistic that this could be a big year, I really don't think you should be deploying money into the junior space unless you're thinking 3 to 5 years out. And so I would encourage investors to tamper their expectations for this year and brace themselves for what could be a lot of volatility coming up. And yeah, we'll just have to see how things pan out. But investors should stick to high quality names managed by management teams with previous successes and large insider ownership positions of north of 10%. And I think if your listeners do that, they should do quite well in the coming years ahead.
Okay, excellent. Well, thank you once again for your time today, Matt. I'm sure we'll have you back on the show later in the year.
Pleasure. Thanks, Graham.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?